I don't like that color. We're going to make it pretty. Okay. We have total units that are on hand of 102 units. No, excuse me, 120.
We gotta do it out to 127.
Yeah, 127. So I just didn't add all these up. So we have 127 units for 13,135.
We already have the info though.
We have the average?
No, I said we have the numbers to get the average.
Yes. So the 13,135 divided by 127 units. So 13,135 divided by 127 units is 103 a unit. Okay? So the way we'll calculate our cost of goods sold would be 102 units times 103. And the way we calculate our ending inventory, 25 times 103. Does that make sense, guys?
Yeah.
Okay. Next. So we have, for the next homework assignment, let me get in here. Written assignment is numbers 1, 4, 6, and 8, problems 3A and 5A. So let's go to number 6. Okay, we're going to work on number 6 now.
Okay.
On December 1st, Quality Electronics has 3 DVD players left in stock. All are identical. All are priced to sell at $85. One of the 3 DVD players left in stock, with serial number 1012, was purchased on June 1st at a cost of $52. Another, with serial 1045, was purchased on November 1st for $48. The last serial, 1056, was purchased on November 30th for $40. We're going to calculate the cost of goods sold using FIFO, assuming that 2 of the 3 players were sold by the end of December. Quality Electronics year end. So there are 3 DVD players, and one was purchased on June 1st at $52. One unit, $52. The next unit, November 1st for $48. And the last unit, June 1st, 52, 48, and November 30th for $40. So we are supposed to use FIFO, which means the first in is the first out, okay? So what would our ending inventory be if we had 1 unit available using FIFO?
40.
40. What would our cost of goods sold be?
100.
Could be
100? Make sense?
yes.
So under the FIFO method, we're going to show with the FIFO method that what's left in inventory is the last item. What's sold are the previous items. Now when we use LIFO, the ending inventory that's left on hand is which one?
52.
52. And the 2 items that were sold,
88.
88. Okay, that makes sense, guys? If Quality Electronics used the specific identification method instead of FIFO, how would it alter its earnings by selectively choosing which particular methods to sell? What would Quality's cost of goods sold be if the company wished to minimize earnings or maximize earnings? So, all are identical, all are priced to sell. So basically, If they use specific identification instead of FIFO, by selectively choosing which players to sell, if they want to minimize their earnings, which means has the lowest net income, which products would we show that were sold?
Basically like how you did the life.
The most expensive ones. This is specific unit. Specific unit.
The 48 and 52,
The 48 and the 52, why?
because it would create the most.
Cost of goods sold.
Cost of goods sold, which should have the least amount of gross profit.
So a specific identification would be the ending inventory unit. We would show the cheapest, right? Which we would show 40. And so it would be just like our FIFO here, right? Okay? So we basically, to maximize the cost of goods sold, to reduce our earnings, we would basically use the FIFO method. What if quality wanted to minimize earnings, or excuse me, maximize earnings? What if in this case they want to show the highest net income? Which specific items would we show?
40 and 48.
We would want to show ending inventory of the 52, and we would show cost of goods sold of the 40 and 40, right, which is just like LIFO, isn't it?
I think in this case, it's just because it's such a small number of units, that's why the numbers are.
Exactly the
coming out
same.
But,
Exactly.
You have 10.
yeah, if you had 10, then it would be, but it's just 3, so.
And so which
Yeah,
method do you
one
want,
item.
which method do you want to use? Well,
Doesn't matter.
basically, it depends on, do you want to minimize income or maximize income? It's your bottom line. Make sense?
Do you think electronics places use this or not really?
Too expensive to use.
Okay. Because I was thinking, like, because you're talking about which ones to use, well, if you got DVD players on a shelf, it's kind of up to the customer which ones they pull off the shelf. And it's not like the salesman's gonna go, oh, take this one instead, this one was brought in at $48.
But-
Oh, okay, sure.
Okay.
It's a little dusty, I don't care, it still works.
Now, E8, or E68. The following comparative information is available for Kaiser. Determine net income under each approach. Assume a 30% tax rate. So what I'm going to do here, just to make it easier, less writing for me. No, that's wrong. It's a homework. So E8, let's look at, under LIFO and FIFO, our sales revenue is going to be the same, but our cost of goods sold is what's different here. So what we're going to do to determine this is we are going to take $86,000, and I'll keep this up for a bit so you guys can look at it. $86,000 is your sales no matter what. Your cost of goods sold they've given you. You end up with a gross profit after that, but they just are keeping it a real simple income statement. After your operating expenses, you've got your net income. You take a 30% tax rate to show the true net income. The difference between FIFO versus LIFO is a difference of about 60, 300. See how that plays out? That makes sense, guys? Now, do you want me to keep that up a minute?
That'd be great.
You guys tell me when I can move on.
I think we're good.
Okay. Now the next portion tells us as we continue on with this problem, it then says to us, determine net cash provided by operating activities under each approach. Assume that all sales were on a cash basis and that income taxes and operating expenses other than depreciation were on a cash basis. So what they're wanting us to see is the cash flow statement. So we have to provide the cash under each approach. So if we go back here, we'll see we start with our sales. We show how much we paid for inventory. Then we show our cash for our operating expenses, the cash we paid for income taxes, and you can see under LIFO, we've got more cash sitting here than we do under FIFO. The main difference is the income taxes were higher. Okay? So truly, the LIFO versus FIFO, we've still spent we've still spent the same amount of money. It's just under LIFO, we're taking the last in, first out, and under FIFO, we're taking the first in, first out. The next asks us, here, I'll hold this a minute. Oops. Everything's the same here except the income taxes. The next then asks us, calculate the quality of earnings under each ratio, calculate the quality of earnings ratio under each approach. So if we deal with the quality of earnings ratio, we're showing the cash from each method divided by the net income from each method. So under LIFO, our quality of earnings is at 2.09. Under LIFO, it's at 1.33. LIFO is going to always result in a higher quality of earnings because the operating activities are going to be the same for both. And since you're taking the more expensive goods,